this is Eric Thompson. I'm the president and founder of Peerless Wealth, LLC, an investment advisory firm located here in Columbus, Ohio. So it is the summer of 2022, and I thought I would talk a little bit about Warren Buffett. I think you hear the name a lot. Some of my viewers may know a little bit more than others do about him, but I think there's some real, he's 91 years old. I'll give you some facts. 91 years old. He's the 5th wealthiest person in the world. So he's obviously done some things right, and I think we can learn a lot. Even though he's 91 years old, I think we can actually even learn more, and it's more about his philosophy than actual specific investments. But we'll talk about both. And his folksy, simplistic approach really resonates well with me, and I'll show a clip at the end of one of my favorite little episodes of Warren Buffett. But I think he bought his first stock when he was 11 years old. And then really he got in the insurance business. In fact, his company, which is called Berkshire Hathaway, they're first and foremost an insurance company. In fact, Geico is one of their primary sources of revenue. So they take in premiums, and when there's claims, of course, they pay out the claims. Well, over the years and over the decades, they've had excess money from all the premiums coming in, so they invested and they started buying publicly traded companies, stocks. And so he developed a substantial portfolio. I think he's worth $91 billion right now. And he's considered to be one of the legendary investors. Why is that? Well, they've calculated his return, and I think since 1965, his average rate of return, which is mostly in this Berkshire Hathaway stock, has been about 20% a year on average, and that compares with about 10% on average of the S&P 500. We're going to talk a little bit later more about that. But one of my favorite illustrations of Warren Buffett is his net worth, or his wealth, by age. So you'll see that come up on the screen here right now. And this also really illustrates the power of compounding. And you can see at age 14 years old, he started with $5,000 of net worth. And you can see at age 30, I'll pick another age, at age 43, he had amassed $34 million. And then look what happened from age 43 to 44, he actually dropped in value, went from 34 million to 19 million. And this is not year by year. You see this is, every few years or so. And then it really starts to compound the last few years because of the way compounding works and the mathematics of doubling. And he wasn't a billionaire until age 56, where he was worth 1.4 billion. And then today at age 91, he's worth 91 billion. So that's it's interesting because it doesn't go up every year. He had stretches where it went down. And really, the last big compounding doublings were later in life. So it illustrates the importance of time in the market, not so much timing the market. So I hear a lot just in passing, people say, well, if I had Warren Buffett's money, or if I had this much money, then I could make a lot more. Well, interestingly, anyone listening to this video can invest exactly like Warren Buffett does. All you got to do is buy shares of Berkshire Hathaway, because that's where his wealth is in. One share of Berkshire Hathaway, I think it's something like $250 a share. So, you buy one share, you're owning the exact same investments as Warren Buffett. And if Berkshire Hathaway makes 14% next year, Warren makes 14%, you make 14%. Now he's going to make a lot more money because he's got more in there, but percentage-wise, you'll get the exact same rate of return. So that's a very easy way to invest right alongside Warren. Sometimes they call him the Oracle of Omaha because he's from Omaha, Nebraska. He's rumored to still live in the same house that he bought 60 years ago when he got married. He's very understated. So now let me talk about what's in Warren Buffett's portfolio of Berkshire Hathaway, and then secondary to that, even more important, his philosophy. So what's in his portfolio? So here's another illustration. And it lists the top companies, and you can see them in there because their logos are there. Apple, Amazon, American Express, Kraft, JP Morgan Chase, Bank of America, Coca-Cola. Big, solid, durable companies. Now, his returns over the last 10 years have not been nearly as impressive as like the first 10 or 20 years. And that's because when you manage 91 billion, you have to buy just the largest companies. You can't buy small companies anymore because it won't move the needle on a $91 billion portfolio. So over the last 10 years, the returns of Berkshire Hathaway have basically mirrored the S&P 500. They both average somewhere between 12 and 13%. It's not so much important that you buy Berkshire Hathaway. I don't think you're going to get a materially different rate of return than if you just bought a quality mutual fund or index fund. I want you guys to understand Warren Buffett's philosophy. And his philosophy is, he always says he's not buying stocks, he's buying businesses. They just happen to be publicly traded. If you owned a dry cleaning business or a restaurant or a medical practice, you think of yourself as a business owner. Now, if it were publicly traded, you could get swayed and nervous about the share price every day. He doesn't. He looks at the earnings, he looks at the dividends, he looks at the revenue growth, and he avoids fads. He was publicly outspoken against, in the late 90s on the dot-com bubble. He thought it would end badly. It did. He warned people about Bitcoin a year or two ago, and that's had a lot of negatives here recently. He buys what he understands, and he buys what makes consistent money over a long-term period. He doesn't get swayed by short-term blips and short-term bumps in the road. In fact, Berkshire Hathaway stock, in its 50 plus years or whatever of existing, has had 3 periods of time that it's dropped 50% or more in value. So let that sink in. And he hasn't changed a thing. He just keeps buying quality companies. And I wanted to end with a video clip that I found online that I think you'll enjoy.
How do you tell the difference between reasonable and unreasonable fear? So in other words, the stock's down, maybe it should be down, or a stock's down, maybe it shouldn't be down.
Well, you just keep looking at the facts. I mean, you're looking at a business. That's the important thing. You don't look at a stock chart. I looked at stock charts for years. I used to have a lot of fun doing that. I was kind of groping around for a philosophy. You look at the business. I mean, how you decide if you own a half interest with some buddy of yours in a McDonald's store, how do you decide, whether it's a successful investment? Well, if the snow's 2 feet out and there's no business today, do you say, well, I made a terrible deal? No, you look at how it's performing as a business over time, how it's doing versus the competition,
So I thought that was worth showing. Hopefully you learned a little bit more about Warren. If you have any questions at all, don't hesitate to contact me, and I hope you learned something today. Thank you.